You spend 3 weeks researching a stock. You read the earnings reports. You watch the charts. You finally pull the trigger and buy. And within 48 hours, sometimes within 48 minutes, the thing drops 4% every single time. It feels personal. It feels like the market knows you bought it. It feels like a conspiracy. It is not a conspiracy, but the real explanation is almost more unsettling than a conspiracy would be. Because here's what's actually happening. You are not unlucky. You are not cursed. You are doing exactly what almost every retail investor does. And the timing of when most people buy stocks is, mathematically, the worst possible time to buy them. Not because of bad luck, because of how the human brain processes information, and because of a gap in investment returns that has now persisted for 15 consecutive years that almost nobody talks about honestly. Today we're going to break down exactly why this happens, the psychology, the math, and the specific behavioral patterns that cause individual investors to consistently buy near the top, sell near the bottom, and end up with dramatically less money than they would have if they'd done nothing at all. Stick with me, because once you see this clearly, you will make better decisions every time you think about buying a stock. Let's start with what actually happens in the days and weeks before most retail investors buy a stock. The stock has been going up. Maybe it's been going up for a week, maybe for 3 months, maybe for a year. The chart looks like it's on a clear trend. The news is positive. Earnings beat expectations. The CEO gave a confident interview. Your coworker mentioned it at lunch. You saw it trending on a financial forum. Everything feels like confirmation that this is a good buy right now. This feeling, the feeling that a rising stock is a good stock to buy, is one of the most powerful and most destructive impulses in investing. It has a name, recency bias, and it is hardwired into the human brain with a depth that no amount of financial education fully eliminates. Recency bias is the tendency to assign disproportionate weight to what has happened recently when predicting what will happen next. In everyday life, this is often a useful shortcut. If it rained the last 3 days, it will probably rain again tomorrow. If traffic was bad on this route last Tuesday, it will probably be bad next Tuesday. Pattern recognition from recent experience is a feature, not a bug, of human cognition. In most contexts. In markets, it is a systematic trap, because what makes a stock go up in the days before you buy it is not the same force that will make it continue going up after you buy it. The price run-up that caught your attention and convinced you this was a good buy was itself the result of other investors, often professional ones with faster information and better analytical tools, buying ahead of you. By the time the story reaches you, by the time the chart looks unmistakably bullish, by the time your coworker is talking about it at lunch, the easy money has already been made. The institutional investors who identified this opportunity weeks or months before you did have already established their positions. Some of them are now looking for opportunities to exit. You are not the first person to notice this opportunity. You are the last. Here's a number that most people in finance know, but almost nobody talks about honestly in public. Dalbar, an independent financial research firm that has been analyzing investor behavior since 1985, publishes an annual report called The Quantitative Analysis of Investor Behavior. It compares what the average individual investor actually earned versus what the market returned in the same period. The 2024 results were published in early 2025. In 2024, the S&P 500 returned 25.02%. A remarkable year, the kind of year that should have made every stock investor significantly wealthier. The average equity investor earned 16.54%. That's an 8.48 percentage point gap. The fourth largest investor underperformance gap since Dalbar began tracking these numbers. But here's what makes this number truly remarkable. This underperformance was not caused by picking bad stocks. It was not caused by investing in the wrong sectors. It was caused purely by the timing of when average investors moved their money in and out of the market. Dalbar documented that withdrawals from equity funds occurred in every single quarter of 2024, with the largest outflows occurring just before a major return surge. The average investor systematically pulled money out at exactly the wrong moment, then watched the market rally without them. And 2024 was not an anomaly. The average investor has underperformed the S&P 500 for 15 consecutive years, not because markets are rigged against them, not because they picked bad stocks, because of behavior, because of when they bought and when they sold. The compounding effect of this behavioral gap is staggering. Dalbar calculated a hypothetical scenario. A $100,000 investment in the S&P 500, held without touching it for 20 years, grows to $717,503. The same $100,000, subject to the timing decisions and behavioral patterns of the average investor over those same 20 years, grows to $345,614. Same market, same time period, different behavior, a difference of over $370,000, more than half the final outcome, attributable entirely to when people chose to buy and sell. So the average investor consistently buys near highs and sells near lows. We've established that, but why? What is happening in your brain in the specific moment when you decide to buy that stock? Let's trace the psychology step by step. The first stage is attention. You don't notice stocks that are quietly sitting flat or slowly declining. Nobody posts about those on Reddit. Nobody brings them up at dinner. The stocks that get attention are the ones moving, specifically the ones moving up dramatically. A stock that's up 40% in a month is visible. A stock sitting unchanged for 6 months is invisible. So the universe of stocks you're even aware of is already pre-filtered for recent strong performance. You're not choosing from a neutral menu. You're choosing from a menu that only shows you winners. The second stage is information gathering. You do your research, and this is where confirmation bias enters. Confirmation bias is the tendency to seek out, interpret, and weight information that confirms what you already believe, and to discount or ignore information that contradicts it. You've already seen the stock chart trending up and formed an implicit belief that this is a good opportunity. Now, when you research, you find the bull case arguments convincing, the bear case arguments easy to rationalize away. The analyst price targets that confirm your thesis seem credible. The concerns that argue against your thesis seem like they're missing something obvious. The third stage is social reinforcement. You mention the stock to a friend, they've heard of it, they say it looks good, this feels like independent validation, but your friend has been exposed to the same information environment you have, the same trending discussions, the same media coverage, so their confirmation is not actually independent. It's the same signal reaching two people through different channels. The herd effect is in operation, and it feels like consensus because it is consensus, just a consensus built on the same shared recent information rather than independent analysis. The fourth stage is the purchase. You buy. And the moment you buy, you now have a psychological stake in being right. This is where loss aversion, one of the most documented concepts in behavioral finance, takes over. Research by Kahneman and Tversky established that the psychological pain of losing $1 is roughly twice as powerful as the pleasure of gaining $1. This asymmetry means that once you've bought a stock, you're emotionally weighted toward defending that position rather than evaluating it objectively. A drop of 5% after your purchase feels catastrophic, not because it's mathematically significant, but because it activates the pain of being wrong. And this is the fifth stage, the sell. Not because you've done new analysis and determined the investment thesis has changed, but because the stock is down from where you bought it and holding it feels psychologically intolerable. You sell. The stock recovers, you've locked in a loss and missed the recovery. Dalbar has tracked this pattern repeating in the data for 4 decades. Now, let's talk about the actual market mechanics that cause the drop you observe after your purchase. Because in addition to the behavioral explanation that you tend to buy at temporarily elevated prices, there's also a structural explanation for why prices often reverse after large retail buying flows. When a stock gets significant attention and retail investor buying accelerates, price rises. This is supply and demand at the most basic level. But that price rise is doing two things simultaneously. First, it's making the stock more expensive relative to its fundamental value, reducing the expected future return. Second, it's attracting the attention of institutional investors who are looking for opportunities to trim their positions at favorable prices. If you're a fund manager who established a position 6 months ago at a lower price and the stock has now risen significantly on retail attention, this is an excellent opportunity to sell some of your position to the retail buyers coming in. This dynamic, institutional investors distributing shares to retail investors who are buying based on price momentum, is not a conspiracy. It's just how markets function. Professional investors have longer time horizons, larger research teams, better access to management, and earlier information than retail investors. They tend to identify opportunities earlier and exit them before the retail crowd arrives. The retail investor arriving on the back of a significant price move is, statistically, buying from someone who identified the opportunity much earlier and is now content to let someone else own it at current prices. There's also a phenomenon called mean reversion that operates independently of investor behavior. Mean reversion is the tendency of asset prices to move toward their long-term average over time. A stock that has risen 40% in 3 months has moved significantly above where its fundamental value would suggest it belongs, unless the business has fundamentally changed, without a corresponding improvement in the underlying earnings power of the business. Elevated prices have a statistical tendency to come back toward the mean. This is not guaranteed. It doesn't happen on a reliable timeline. But the mathematical reality is that buying a stock significantly above its historical valuation, multiples carries meaningfully higher risk of near-term reversal than buying the same stock when it's attractively valued. The cruel irony is that the conditions that make a stock look most attractive to most retail investors, strong recent performance, positive news coverage, widespread discussion, are often the conditions that make it most expensive on a fundamental basis. The stocks that are genuinely cheap, genuinely undervalued relative to their earnings power, are almost never the ones generating excitement and attention. Let's get concrete. These are the specific behavioral patterns that cause most retail investors to buy at the wrong time and sell at the wrong time. And what to do instead. The FOMO buy. You've watched a stock rise 30% over the past 2 months without owning it. The feeling of watching gains you could have had is one of the most powerful negative emotions in investing. Fear of missing out causes investors to buy at elevated prices after a significant run, exactly the scenario described above. The antidote is not suppressing this feeling. That doesn't work, but building a process that includes a mandatory waiting period before acting on it. If a stock is still on your buy list after 30 days of deliberate evaluation, it belongs on your buy list. If the impulse passes after a week, it was FOMO, not analysis. The news buy. A company beats earnings expectations. The stock rises 8% on the news. You buy because the business clearly seems to be performing well. The problem is that earnings surprises are already priced into the post-announcement price. What matters for future returns is not whether this quarter was good, but whether future quarters will be better than what the market is currently expecting. The news that caused the price to rise has already been absorbed. You're now paying a price that reflects that news, plus the excitement around it. The loss aversion sell. Your stock is down 12% from where you bought it. Every day it sits in the red is psychologically painful. The rational question is, has anything changed about the fundamental reason you bought this stock? If the thesis is intact, the lower price is actually a better entry point than when you bought it. The stock is now cheaper relative to its earnings power. If nothing has changed about the business, you're evaluating whether to sell based on your purchase price, a number that is economically irrelevant. Your purchase price has no effect on what the stock will do next. The market does not know or care what you paid. The success extrapolation. A fund or stock or sector that has returned 25% per year for the past 3 years is one of the most dangerous looking opportunities in investing. Investors allocate heavily to strong recent performers and underallocate to recent underperformers. Dalbar found that in 2024, investors increased contributions to bond funds even as fixed income posted a negative return, because bonds had been strong before. They simultaneously withdrew from equities at the worst possible moment. They were extrapolating recent performance in both directions simultaneously, and both extrapolations were wrong. Here's the honest answer to the question this video started with. Why does your stock drop right after you buy it? Because by the time you're aware of it, excited about it, convinced it's a good buy, and have done your research confirming that thesis, the factors that drove the price up to the level you're buying at have already been in the market for weeks or months. You're not wrong about the story. You're late to the story. The solution is not to become a smarter stock picker. The evidence that individual stock picking consistently outperforms the market is extremely thin, even for professionals with full-time research teams. The solution is to restructure how and when you make investment decisions, so that your behavior is less likely to be the factor that costs you. Dollar cost averaging, investing a fixed amount on a regular schedule, regardless of market conditions, doesn't feel exciting. It doesn't feel strategic. But what it does is remove the timing decision from the equation. When you invest $500 on the first of every month, regardless of what the market did last month, you stop making buying decisions based on recent performance. You buy some shares at high prices and some at low prices, and your average cost ends up somewhere in the middle, which is exactly what the data shows is better than what most people achieve through active timing. Morningstar's Mind the Gap report found that average investors earn roughly 1 percentage point less per year than the funds they invest in. Not because the funds are bad, but because investors buy them after strong performance and sell them after weak performance. Switching from active timing to scheduled buying removes this gap almost entirely. The second structural change is to stop checking your portfolio as frequently. Research consistently shows that the more often you look at your portfolio, the more likely you are to trade. And the more you trade, the worse your outcomes. An investor who reviews their portfolio quarterly makes fewer emotional decisions than one who checks daily. An investor who checks daily makes fewer emotional decisions than one who checks every hour. The frequency of attention is itself a risk factor. The third structural change, and this one is the hardest, is to develop a written investment thesis for every position you hold and to evaluate selling decisions against that thesis rather than against the price. If you bought a stock because you believed the company's new product line would generate significantly higher margins over the next 3 years, that thesis is either intact or it isn't. The stock being down 15% from your purchase price is not a data point about the thesis. It's a data point about what price other investors were willing to pay yesterday. Those are different things. So here's what's really happening when your stock drops right after you buy it. You are buying after a period of strong performance, which means you're paying a price that reflects the optimism generated by that performance. You are experiencing the natural result of a market where prices are set by thousands of participants who have processed the same publicly available information, meaning by the time something looks obviously good to you, it looks obviously good to everyone, and the price already reflects it. And you are, in all likelihood, experiencing the statistical reality that stocks which have significantly outperformed in the short term have a higher probability of mean reverting in the near term than continuing at that pace. None of this means the stock is a bad investment. It means the timing of your entry was driven by factors, recent performance, media attention, social reinforcement that are reliably poor predictors of future returns. The investors who consistently outperform are not necessarily smarter than you. They are more disciplined. They have built processes that remove behavioral decisions from the equation. They buy when things are unpopular and uncomfortable, not when everything feels obviously right. The market drops right after you buy, not because you jinxed it, but because the conditions that made you feel ready to buy are structurally the conditions under which you're paying too much. Now, the question is what you do with it.